SPY, VOO, and VYM are three popular ETFs, but they serve different investment strategies. Choosing the best one depends on whether you want to track the S&P 500, focus on lower costs, or invest in high dividend-paying stocks. SPY, or the SPDR S&P 500 ETF Trust, is the oldest and most well-known ETF that tracks the S&P 500 index. It includes the 500 largest U.S. companies, making it a strong choice for investors who want exposure to large-cap stocks. However, SPY has a higher expense ratio of 0.09% compared to its competitors. It's often used by traders due to its high liquidity and trading volume. VOO, or the Vanguard S&P 500 ETF, also tracks the S&P 500 index, but it has a much lower expense ratio of just 0.03%. Since both SPY and VOO follow the same index, they have nearly identical performance over time, but VOO is cheaper to hold long-term. Investors looking for a low-cost, passive way to invest in the S&P 500 often choose VOO over SPY. VYM, or the Vanguard High Dividend Yield ETF, is completely different from SPY and VOO because it focuses on high dividend-paying stocks. Instead of tracking the entire S&P 500, VYM includes companies with strong dividend payments, such as Johnson & Johnson, Procter & Gamble, and JP Morgan Chase. It's designed for investors looking for income through dividends rather than just price growth. Now, let's compare them side by side. First, expense ratios. SPY has the highest expense ratio at 0.09%, while VOO is the cheapest at 0.03%. VYM is slightly higher at 0.06% due to its specialized dividend strategy. If keeping costs low is your priority, VOO is the best option. Next, focus and strategy. SPY and VOO both track the S&P 500, meaning they focus on large, stable companies. VYM, on the other hand, selects companies based on their dividend yields, which means it has a different composition than the S&P 500. If you want general market exposure, SPY and VOO are better. If you want dividend income, VYM is the best choice. What about performance? Historically, SPY and VOO have provided strong returns in line with the S&P 500, averaging around 8 to 10% annually over the long term. VYM has slightly lower growth, but provides more income through dividends. If you're looking for higher overall returns, SPY and VOO are better. If you want steady income with less focus on price appreciation, VYM is the way to go. Now, let's talk about dividends. SPY and VOO pay dividends, but their yields are lower since they track the broader market. VYM focuses specifically on high-yield dividend stocks, meaning it pays out significantly more income to investors. If earning passive income through dividends is important, VYM is the best choice. Finally, liquidity and trading volume. SPY is the most actively traded ETF, making it ideal for short-term traders. VOO and VYM have lower trading volumes, but are still highly liquid for long-term investors. If you're a trader, SPY is the best option. If you're a buy-and-hold investor, VOO or VYM are better. So which one is the better choice? If you want the most cost-effective way to invest in the S&P 500 for the long term, VOO is the best option. If you prefer a highly liquid ETF for active trading, SPY is a better choice. If you're looking for dividend income and are less focused on high growth, VYM is the best fit. The best ETF depends on whether you prioritize low costs, trading flexibility, or passive income.